In September 2008, the world didn't collapse with an explosion. There were no sirens, no warnings, no countdown. Instead, it froze. Screens went blank. Phones stopped ringing. Banks stopped trusting banks. And for the first time in modern history, the global financial system stood still. What followed would erase trillions of dollars, destroy careers, bankrupt nations, and reshape how money itself works. But here's the question few people ask. Was the crisis an accident or the result of a decision made years earlier, quietly, legally, and in plain sight? To understand the meltdown, we need to rewind, not to 2008, but decades earlier. Because financial disasters are never sudden. They are built slowly, layer by layer, choice by choice. In the years after World War II, banks were boring. And that was intentional. Strict regulations separated commercial banking from investment banking. Banks took deposits, they issued loans, and they stayed out of speculation. Risk was controlled, failures were contained. But boredom doesn't generate profits. By the 1980s and 1990s, Wall Street wanted more leverage, more innovation, more freedom. New financial instruments emerged. Derivatives, swaps, and complex securities that promised higher returns with managed risk. At the center of this transformation was a simple idea. Risk could be sliced, repackaged, and sold. Enter mortgage-backed securities. Banks began bundling home loans together and selling them to investors. At first, it was safe. Then came a dangerous realization. If you could sell the loan, you didn't need to worry about whether the borrower could repay it. And so standards fell. Loans were issued to people with no income verification, no job security, no assets. These were called subprime mortgages. And yet, they were magically labeled as safe. Why? Because rating agencies, paid by the same banks creating the products, stamped them with top-tier ratings. AAA, the highest level of trust. Investors around the world bought in. Pension funds, insurance companies, foreign governments. Everyone wanted a piece of what looked like free money. Housing prices kept rising. And as long as prices rose, the system held. But underneath the surface, leverage was exploding. Banks weren't just holding these securities, they were betting on them, borrowing massive sums to amplify returns. Some institutions were leveraged 30-1, meaning a tiny loss could wipe them out. Then came the trigger. Interest rates rose, mortgage payments increased, borrowers defaulted. One by one, the weakest loans collapsed, and the dominoes began to fall. At first, Wall Street dismissed it. This is contained. It wasn't. Because no one truly knew who held the risk. Derivatives had spread exposure across the globe. Every bank was connected. Every balance sheet was suspect. In March 2008, Bear Stearns collapsed. It was rescued. That rescue sent a dangerous message. Big banks would be saved. Risk-taking accelerated. Then came September. Lehman Brothers, a 158-year-old investment bank, was allowed to fail. No bailout, no safety net. The decision shocked markets. If Lehman could fall, anyone could. Overnight, trust vanished. Banks refused to lend even to each other. Money markets froze. Global trade stalled. Companies couldn't make payroll. The modern economy ran out of oxygen. Governments panicked. Emergency meetings, trillion-dollar rescue packages, unprecedented interventions. The US government injected capital into banks. Central banks slashed rates. Money was created at a scale never seen before. The system survived, but the damage was done. Millions lost their homes, millions lost their jobs, entire countries entered recession. And yet, very few decision makers faced consequences. Which brings us back to the real question. Who caused the meltdown? Was it greedy bankers, weak regulators, faulty models, or a system designed to reward short-term profit over long-term stability? The truth is uncomfortable. The crisis wasn't caused by one villain, it was caused by incentives, by institutions rewarded for risk and shielded from failure. Even today, echoes of 2008 remain. Markets are larger, products are more complex, leverage still exists. The names change, the behavior doesn't. History doesn't repeat itself exactly, but it rhymes. And the lesson of 2008 isn't that markets are evil. It's that unchecked systems, no matter how sophisticated, will eventually break. Because when profit is privatized and losses are socialized, the bill always comes due. Welcome to Cash and Chronicles, where money, power, and history collide.